Dear viewers, welcome to Scalpers Club. In this video, we discuss ETF and why investors prefer ETF for their investments to mutual funds. We also evaluate the recent development in the market for the benefit of investors in ETF. So, we can start from the basics. What is ETF? ETF means Exchange Traded Fund. It is a collection of investments such as equities, gold, bonds, or other assets. ETFs are funds that track indexes such as Nifty 50 or BSE Sensex. ETF trades like a common stock on a stock exchange. The traded price of an ETF changes throughout the day, like any other stock. Because it is bought and sold on the stock exchange, ETFs can replicate the return of the benchmark index. It helps investors benefit from the diversity, flexibility, and scope for growth from trading. ETFs are passively managed. Passive management is the chief distinguishing feature of ETFs, and it brings a number of advantages for investors. Essentially, passive management means the fund manager makes only small, periodic adjustments to keep the fund in line with its index. Mainly, there are 6 types of ETFs are there. They are equity, gold, bond, sector-specific, international, and smart beta ETFs. Equity ETFs means these ETFs invest in stocks of companies listed on the stock exchange. They provide exposure to a specific sector or index, such as Nifty 50 or BSE Sensex. Gold ETFs are investing in physical gold and provide exposure to the price of gold. Bond ETFs invest in government or corporate bonds and provide fixed income exposure to investors. Sector-specific ETFs invest in companies operating in specific sectors such as banking, technology, and energy. International ETFs invest in companies listed on foreign stock exchanges and provide exposure to international markets. Smart beta ETFs are designed to track indices that are constructed using a specific set of rules or factors such as value, momentum, or low volatility. Now, we can see how to select the ETFs. We cannot say that all the ETFs are equally good. We have to consider some parameters before investing in ETFs. First, you have to consider the index. Which index is suitable for your portfolio? Many types of ETFs are available in the different asset classes. The best ETF asset class for investment in India depends on an individual's investment goals, risk tolerance, and investment horizon. Next, we need to consider the tracking error. It means the deviation of the ETF returns from that of the index is measured by the tracking error of the fund. Higher the tracking error, greater is the deviation, which is not a positive feature. Next, we need to evaluate the liquidity. It means being able to transact in the units easily at prices that reflect the NAV of the scheme. Why investors in India prefer ETFs to mutual funds? We can discuss the reason. The first one may be the lower costs. ETFs typically have lower expense ratios than actively managed mutual funds, which can add up to significant savings over time. Second reason may be the greater flexibility. ETFs can be bought and sold at any time during market hours, while mutual funds can only be bought or sold at the end of the trading day at their net asset value. Transparency may be the next reason. ETFs are required to disclose their holdings on a daily basis, which allows investors to see exactly what they are buying, whereas mutual funds disclose their holdings less frequently. Diversification is the next reason. ETFs offer a diverse range of investment options such as sector-specific, bond, gold, commodities, etc., which helps investors to diversify their portfolios. Tax efficiency may be the last reason. ETFs are more tax efficient than mutual funds, as they do not trigger capital gains taxes when shares are sold, unless the shares are held for less than a year. Apart from these fundamental reasons, we can see some recent developments shown in the media. As found in The Economic Times, 61% equity mutual fund schemes failed to beat benchmarks in 5 years, and around 62% schemes underperformed their benchmarks in the 7-year horizon. Shown in moneycontrol.com, in April 2022, the assets under management or AUM of Nifty 50 index-based ETFs crossed 2 trillion rupees mark. It traversed the distance between 1 trillion rupees and 2 trillion rupees in just 20 months. The previous landmark was hit in August 2020. We think the promising news for the investors is this, which we found in the Economic Times, about the prediction of India's growth. As per the report, both RBI and the International Monetary Fund (IMF) have forecast 6.8% growth in financial year 23, while the World Bank has pegged it at 6.9%. Gross domestic product (GDP) had grown 8.7% in financial year 22, boosted by the pandemic-induced low base of financial year 21. So, if you trust in the Indian economy, you can start a move to investment in ETFs. To start the investment in ETFs, you need a demat account and trading account. If you don't have one, please check the description to open one among zero broker to full-service brokers. Thanks for watching the video. Please like and subscribe to the channel. Comment below if you have any doubts.